Antonio, thank you very much indeed. A terrifically lively address. Peter, yesterday in your talk and this morning you mentioned, this morning you mentioned a phrase. I think it was the policy community. A phrase I'd never heard before, actually, but the moment I heard it, I recognized the truth of it, and also it has a slightly unsettling sound as well. I think a lot of people here are members of the policy community, and we're used to conferences in which other members of the policy community talk to us and we ask them questions. But it's obviously important in a topic like this to have members of market participants. Well, we're talking about enormously important institutions called markets. I mean, the members of and the people who operate in them know a great deal about how the things work, which the policy community knows at a remote distance, at third hand. And so we were very keen today to get some market participants, and I'm very fortunate in having as our next speaker, a market participant who is Mr. Hollihan, who is Jack Hollihan, who is, if you look at his record, he has been on both sides of the Atlantic in major financial institutions, Morgan Stanley being one of the most famous. He's been involved in the privatization that have revolutionized the market in the last few years. He is presently the president of Litchfield Capital Holdings, but he's also, I think I've got that title wrong actually, Jack, but also a director of organizations and businesses like Armour, and you're in a unique position therefore on the panel of somebody who knows how these operations work, or else you don't have a living. So I want to invite you to tell us how you think the crisis developed in the markets and spread more widely. Jack Hollihan.
Thank you, John, for the introduction. I'm not sure that I'm not the Philistine in the crowd or the dog in the manger or what, but I'm speaking from a very much a private sector perspective on what were the factors coming out of Wall Street that contributed to the 2008 financial crisis. And frankly, they're pretty easy to see now in retrospect. They were much harder to see then. What were they? There were really five in my view. The first was the radical change in the US banking landscape and who ran the show at the banks. As background, prior to the sort of mid-1980s, there were broadly two types of banks in the United States. The first type was the investment banks. And some of the names of those banks were Morgan Stanley, Goldman Sachs, Lehman Brothers, Kidder Peabody, Dillon Reed, First Boston, etc. The banks then were small, and they didn't have very much capital. To give you a sense, when I joined Morgan Stanley in the mid-'80s, I was the 2,340 person joining the bank. That was its size, a little bit over 2,300 people. Now it's more than 45,000 people. These were small entities. They didn't have much capital. They were privately owned by their partners, and their business fundamentally was helping their clients to buy and sell companies. That was the mergers and acquisition business, and helping their clients sell stocks and bonds. They put together buyers and sellers and made a fee. That was it. And attached to each of these investment banks were really small trading operations that made or lost money trading stocks and bonds for the banks, for the investment bank's own account. The second type of banks were commercial banks. Bank of America, Wells Fargo, JP Morgan, Chase Manhattan, Manny Hanny, Citibank, and the like. They were by and large big, they were conservative, and they had a lot of capital in the very basic business of taking in deposits and making loans. Now within 10 years, all of that was gone in the US. And it was replaced by much larger investment banks, loaded with capital, and with big, aggressive, what were called universal banks that combined investment and commercial banking, And they were likewise loaded with capital. And most of the banks, the investment banks, were now run by traders, investing for their own bank's own account and driven to make money. And when we're talking about money, I mean lots of it. Now, how did that happen? It's really for two reasons. First is starting with the most prestigious investment banking firms, they figured out that they could issue their shares to outside investors. And in the mid-'80s through the early 1990s, most of them did so, and we raised tons of capital in the process. Secondly, the Glass-Steagall law, which was in place since the 1930s, was repealed by the Clinton administration in 1999. That law required the separation of investment banking and commercial banking businesses. And with the repeal, the more aggressive investment bankers could now combine their way into the commercial banks and get their hands, frankly, on the commercial bank's capital. And they did. So, why was that dangerous? What did that do? It changed the financial sector's culture radically. On Wall Street, as well as I'm sure all other places, power goes to those who make the money. And the traders, with all this capital to play with, suddenly were making most of the money for the investment banks. So the traders took over control at the banks from the investment bankers, who were basically brokers. Examples: John Mack at Morgan Stanley, John Corzine at Goldman, and so forth and so on. Now, I'm an investment banker, so you're going to hear bias in this following part. But most traders, by nature, are short-term, what's in it for me, aggressive personalities. They're typically far less sensitive, given the nature of what they do, than investment bankers about long-term franchise value or long-term reputation. It's about the money, and it's about the money now. And that's because, fundamentally, a trader doesn't need long-term clients to make money. He just needs capital. The result was a Wall Street culture that moved from our reputation is key, or the Morgan Stanley internal motto, we only do first-class business in a first-class way, to short-term profit-making and, in effect, buyer beware. But the bank's reputation for fair play carried on, at least until the crisis. And a lot of investors got burned by not seeing this change in culture at the banks. So that's the first factor. You have a change in banking culture. The second factor was the change in technology, both in computing power and in communications. When I started at Lazard in the 70s, the first stuff that I was working on was pricing leveraged leases for Air France. And it was a joint effort by Lazard New York, where I worked, and Lazard Paris in London. My technology, my computing technology for pricing these leases was a 13-column spreadsheet, a 12C calculator, a slide rule, and a pencil. That was it. You did one computer run at the end of the transaction, which cost you $1,000 for that one run. That was it, right? In terms of communication, how you communicated with Lazard Paris to talk with Air France was you sat at your desk and you wrote out a telex. And then you took it upstairs to the Lazard telex room, which was occupied by these huge women with these beehive hairdos who were tougher than nails. And if they liked you, it was sent, and if they didn't like you, it went to the bottom of the pile. And at the end of the day, you wouldn't hear it back until the next day from Lazard Paris. So understand that the financial technology, the ability to move money globally and to do transactions in various capital homes was literally impossible. By the time you got to the late 80s and early 90s, massive computing power was available to us, and it was cheap. As a result, you could analytically break apart, determine the business with slice and dice, any set of cash flows you might want, and then project how each of these broken apart segments could presumably perform in the future based on how they historically performed in the past. And if you could do that, you could shape those segments of cash flows any way you wanted. You could slice them and dice them any way you wanted and turn them into any number of financial products to be sold. And there are literally trillions of dollars or euros or whatever per year of these identifiable cash flows. Credit card receivables, residential mortgage payments, commercial lease obligations in any major economy. So the size of the opportunity to slice and dice these cash flows and then put them together and sell them off was huge. And you could pick up the phone now to anywhere because of the communications revolution. Calls were now cheap, and at every one of the firms there were open tie lines from the US offices to all the European offices and all the Asian offices. So, and through your bank colleagues, you could then sell these new products piece by piece to anybody in the world, having first tailored them to the investor's precise needs. So this is a huge opportunity to make a lot of money, and Wall Street did. The third factor was that technical credit analysis based on historical performance. And this was usually represented by a third-party credit assessment in the form of a credit rating, Moody's, S&P, Fitch, etc., became essentially the sole thing relied upon by buyers of financial instruments. And that was especially so for these new financial securitization products of segmented cash flows. It was the only thing out there to benchmark their intrinsic merit, their intrinsic performance. And as we know, history is not a particularly good guide, especially when the underlying bases for these cash flows change, as Peter so correctly and elegantly pointed out, as, for example, mortgage cash flows were affected by changes in public policy, which basically meant that the solidity of those cash flows deteriorated. But if you looked at history, you never saw it coming. So, why did people start relying basically on credit ratings? Because everybody was doing a lot of volume, and there were very willing buyers, and frankly, it was the easy way forward. And why was there such strong demand for this? Because these financial products were sold with marginally higher yields, or marginally higher returns. And they were sold especially to those with lots of money to put to work and insufficient opportunities, as they saw it in their home markets. For example, the German Landesbanks were big buyers of this stuff. So the buyers allowed themselves to invest for a bit more yield than in their home country in financial products they really didn't understand, nor did they evaluate well. So greed triumphed over fear, frankly. The fourth factor was, for a while, that investment strategy really worked well for the buyers. The underlying economies producing these cash flows were performing reasonably well, so the cash flows supporting these payments or supporting these financial products continued to be made, and history continued to tell you, this is good, right? These things will be fine. So what that did was, of course, we moved from the Baroque to the Rococo period in financial products, and what it meant was that even more dangerous financial products could be and were developed and sold to very willing buyers. So, the fifth factor, when the music stopped, and it always does, the world concluded, as it always again does in financial panics, that the end of the world had come, right? It's over. So it was every man for himself, and nobody knew who it was safe to lend to. Hence, illiquidity froze the financial markets. Not insolvency yet, just illiquidity. But the difference was on this one, was that Wall Street did not then fix itself, as it had done in all prior bank panics, by mitigating the crisis damage itself and calming the fears. Instead, Wall Street gave in to Washington pressure to let a major player, Lehman Brothers, simply go bankrupt. And that meant that roughly $600 billion of Lehman obligations were no longer reliable. And that ripped the sinews or the guts of the financial sector globally to shreds, which frankly we're still in the process of rebuilding. This last factor, letting Lehman go, greatly exacerbated the crisis. Now, what am I talking about when I say this? Most financial firms are quite leveraged, and they can't suffer major book losses out of the ordinary course of business, even if those losses are only interim market pricing losses. And that financial institutions are leveraged has been going on since the early 1600s. This is not a surprise. This is not a change. They always are, right? So, but they can't suffer heavy, sudden book losses. Second thing is banks and financial institutions often lend to each other. So that creates a highly intertwined financial web of interrelated obligations so that the failure of a major participant takes down the weak and the strong. With that in mind, in all previous financial U.S. crises, Wall Street clubbed together to take over the failed firm, however big it was, parceling out its business, taking over its assets. You wipe out the equity shareholders, but you effectively support the failed institution's debt obligations. Again and again and again. Continental Illinois Bank blows up, it gets taken over by another bank by a club deal. The Texas banks blow up in 1984, 85, same thing. LTCM blows up in 1987, gets sorted out, gets clubbed out by Wall Street. The same could have occurred in 2008, and in fact, this had just happened to Bear Stearns, which JP Morgan took over. Equity shareholders were wiped out, business went over to JPM, obligations were supported, right, and the system stabilized. But there was one other bank that was particularly suffering, Lehman Brothers. It was under pressure, but frankly, it likewise could have been worked out given time. Sizable, big hit, but sortable. The problem was that Hank Paulson, who was the ex-head of Goldman Sachs and now Secretary of the Treasury, and the folks down in Washington took the position that Lehman Brothers should simply go under and not be kept alive long enough to be the subject of a typical Wall Street workout. This had never been permitted to happen before. Most recently, even with Bear Stearns, and Bear Stearns was the baddest of bad boys on Wall Street. If anyone should have been taken out and just dropped like Lehman was, it was Bear Stearns. And most senior people on Wall Street hated the management of Bear Stearns because in the last major crisis, which was LTCM, Bear was the only bank on Wall Street not to contribute to the bailout, to the workout. So if anyone should have gone, it should have been them. Instead, it was Lehman's. Now, why did Wall Street bow to Paulson's wishes? Because he represented the US government with huge power over the banking business. Washington can blow you up, and everybody knew it. So, the result was billions of Lehman obligations were no longer money good. Everybody globally took severe book losses, directly or indirectly. Confidence completely collapsed. A number of other firms became crippled through the write-downs that resulted, and we now are where we are as a result. And only through dumping massive amounts of cash into the system, frankly to inflate asset values and therefore bail out financial balance sheets, have we mitigated the damage. And the collateral consequences of doing that, right, are yet to be seen. So, how did Wall Street help us to get us where we are? 5 things. Change in leadership and mentality from long-term relationship banking to short-term trading. Change in computer and communications technology, allowing new and attractively priced financial products to be sold. created and sold globally in scale. Frankly, both US and global investors, and especially investors in these new financial products, failing to do their homework and instead relying on third-party credit ratings to make their investment judgment. The ironic fact that this worked like a charm for a while before it all blew up. And then finally, the failure of Wall Street to push away the US government and the failure of the US government to support Wall Street's normal internal process for cleansing itself. With all that, I'd observe that if you look at the nature of these factors, the crisis was fundamentally not avoided by prior regulation. You can't legislate morality, you can't legislate wise behavior, you can't avoid human frailties. They're part of life and you have to deal with it. The second thing is that when you say, well, notwithstanding all that, we're going to sort this by regulating the banks, right? You have collateral consequences that you're now seeing in the US, right? Which are, be careful of what you ask for, you may get it. Meaning, Dodd-Frank is supposed to stop the financial sector from engaging in these immoral excesses that they always do. Fine. Well, the problem with Dodd-Frank and the related legislation is now we have crony capitalism in the US, right? You're not relying on the market to get funding for businesses. You're relying on who you know, right? And that is a terrible mechanism to allocate resources. And we're seeing the damage to the US economy and US growth as a result. The third thing is that the financial systems periodically crash, financial sectors periodically crash and burn. It's part of the typical cycle of market growth, and then you have excess, and then you go into the Rococo period, and then everybody panics, and then after a bit of time, there's renewal on the ashes. And I've been doing this for approximately 40 years, and having been part of this close up, it's very clear to me that in terms of financial crises, it's not whether it happens again, right, but when, and it's going to be again and again. So the wise investor, the wise government, wise people will recognize this and be ready not to prevent these cleansing effects, but rather to rationally and fairly manage the consequences when these crises occur. In 2008, we didn't. We're paying the price. Thanks.